Hey traders, this is Blake Morrow with Trader Summit. And with me, because it's Friday, I have Mr. Jim Welsh from Macro Tides. Good to see you, Jim.
Hey, great to be with you, Blake.
All right. Well, before we get started, I got to say this. Every week, Jim Welsh joins you guys and he gives you a good macro backdrop of the market, technical views of how he sees the markets. If you like these videos, you like this content, click thumbs up if you're watching us on YouTube for Jim. Also subscribe to the channel so you don't miss any of these Friday interviews that we do with Jim. So Jim, look, we got a lot to unpack this week. We had Jerome Powell. He got, he went through his, his hearing, and the markets reacted a bit there. And I want to ask you, how did you read the price action following, the dollar weakness, stocks ripped back? Was he really that far off base, off message, what we've seen? What do you think here?
Well, I think the markets misinterpreted what he conveyed. The markets want to have a bias always of the Fed being accommodative, supportive, the notions of, the market, the S&P as a Fed put in place and so forth. And so they heard what Powell, let me back up. The week before the minutes came out, everybody got worried. Oh my God, the Fed is going to get real aggressive really quickly. And Powell kind of just said, okay, this is what we're going to do. We're going to taper, then we're going to raise interest rates, and then perhaps we will shrink our balance sheet. And so just that measured pacing, I think, led a lot of people to think, okay, they're not going to go off a cliff. But what I keyed off of is that he used the word inflation is a severe threat. I don't think I've ever heard a Fed chairman use the phrase severe threat. And so to me, that is the real crux here, Blake, because in my opinion, what it implies is that the resolve of the Fed is much stronger than I think the markets fully appreciate it. And, to me, what that means is the Fed, I think, is going to follow through sooner rather than later. And I think, if you think about it, and I'm sorry for kind of rambling here a little bit.
Fine.
The Fed's greatest fear is that at some point in time, 12 to 18 months from now, inflation's higher than expected, and they're forced to ramp up rates at a time when that might tip the economy into recession or slow it significantly. That's what they really want to avoid. So to me, going from 0 to 75 basis points is the easy lifting. The sooner they do that, the better. So my take is I think there's a real high probability that they will raise rates in March, May, June. And as we've discussed before, and as I've written about a lot in my letters, is that in the second quarter, we are going to see inflation come down just because of the year-over-year calcs. So to me, you have a scenario where the Fed can go from 0 to 75. That is not going to do undue harm to the economy. It's going to regain some credibility. And at that point in time, some of the inflation numbers are going to be supportive for them to hit the pause button. So I think that's what's more likely, is that they'll do a lot quickly and then be able to stand back.
So I mean, right now you're thinking there's 3 rates, but so is the market really off base by thinking there's going to be possibly 5 rates going into 2022, or is that just the fool's thought?
I think that's a little excessive. Okay. Again, Goldman Sachs came out last week and said 4 rate hikes, which was, they went from 3 to 4, but they said March, June, September, December. That's like taking a stroll in the park. We're just going to do it every 3 months. Well, that doesn't, in my opinion, doesn't jibe with a severe threat. If you're facing a severe threat, you react forcibly. And so to me, a rate increase every 3 months doesn't measure up. And again, the economic impact from doing 3 rate hikes in the next 4 or 5, 6 months, call it, I don't think is going to impair the economy all that much. Secondly, the idea that, oh my God, if the S&P drops by 10%, the Fed's going to run to the rescue. If you're facing a severe threat, your goal is to contain and address that threat. There may be some collateral damage, but you want to address that threat because in their mind, they want to do, if they can, a soft landing. Powell, especially as he's kind of delineated, really wants to try to keep the economy going, labor market improvement, wage growth, especially for lower income people. And, one of the threats to that would be, at some point in time, they're so behind the curve that they have to raise rates more just in time to tip the economy in recession. That is the history of the Fed. If you go back the last 60, 80 years, They always go too far, and then you have a recession. They're driving the car looking through the rearview mirror always, and that's a tough job because it takes time for rate increases to fully impact the economy. So that again is why I think they're smart to front load those 3 increases, and then say, you know what, inflation's coming down a little bit, and we've done a fair amount of already. This gives us a chance to stand back a little bit. And so that's been my thesis for really a couple months, that we would see the market, the S&P decline 10 to 15% in the first quarter as people realize that, hey, this is what's coming. And then I think you got a big rally starting before mid-year that takes the S&P up to new all-time highs when the Fed hits the pause button.
Okay, so let me ask you this. Then you think that these rate hikes could be very well front loaded, because a lot of people right now are worried about worried. I think this from a trader's perspective. We've had a lot of talks about, hey, what other hawkish U.S. dollar news are we going to get right now? What's going to be so bearish for equities? When we have all of these expectations already priced in, but really front loading or doing rate hikes quicker, at the beginning of 2021 could be what tips the scales a little bit, right? Because I think a lot of people believe that the dollar's rally is kind of done here.
It's possible, as you know, for weeks, I was looking for a pullback in the dollar, that it would decline below 95.51, drop to about 94.50 to 75. Those were kind of the higher, prior highs.
That was the resistance, yeah.
Resistance now becomes support. I think that's wave 4. And we're going to see the dollar rally again, I think, to new highs, recovery highs above 97. And then I think you get a top. Positioning is starting to get excessive. Bullishness is starting to get excessive. But if you look at back the last 5 years or so, Blake, they're not quite to the levels that we've seen prior to other important tops.
Yeah. And the thing is I think everybody's cued on to believing, and let's just go belief system right now, that, everybody was wrong-footed in the end of 2020. Everybody's wrong-footed in 2021. And we're going to get the exact opposite, same, but opposite result. And that story usually doesn't play out quite like that, does it?
No, it doesn't. And the other thing I'll mention, I thought the dollar was likely to bottom around 89.5 in May and June. All right. And part of that was the Fed is going to move toward less accommodation well before the ECB. That would be supportive, right? So I think what we're going to see is at some point in time, you get a crossover where people start to look at what the Fed is doing, and they start looking out 12, 18 months. Is the US economy going to be stronger or weaker? So, it's counterintuitive. It's so logical to say, well, central bank raises rates, that's good for the currency. Well, to a point, at some point in time, people start to look at the economic repercussions. And I think as they see that, all right, the Fed is serious about this, initially you might get that move above 97. But I think then it shifts to, wait a second, the US economy is going to slow down. And then sometime in the next 6 months, we're going to see the ECB become a little more hawkish.
Yeah.
And I think that swings the if you will, the tide in favor of the euro, which is why I think then the dollar can come down. So
did you just use that pun intentionally?
Probably. I say I did because that sounds like a compliment.
Turn the tide, maybe the macro tide. Hey, real quick, and just a few minutes ago, Nel Kashkari, he also said, we're seeing very high inflation right now, surprised by how high and persistent. So this isn't just from the Fed chair. You're seeing other
all the way down the ranks.
Yeah. Okay.
And this is one of the points I made in the Monday weekly technical review, Blake, is you're going to see speeches coming from all the Fed presidents that are going to be really hawkish. They believe in this concept called forward guidance. They think that the words that they say is going to affect how people behave. Personally, I don't put much stock in it, but they put a lot of stock in it. And the chart we have talks about inflation expectations and how high inflation has already jumped based on a 1 and 3 year time frame. So my point is they're sensitive to inflation expectations. They believe that tough talk will help manage that. and show that the Fed is really serious. So that is to me, one of the points. In the next 2-3 months, you're going to hear a lot of Fed presidents giving speeches, talking very hawkishly. And Kashkari is the most dovish member of the Fed board. And so it's a great point. From the top all the way down to the bottom rung, they're starting to talk tough. And again, this is what I think the markets haven't fully comprehended yet, because the Fed has been very dovish for a long time. I look at this, Blake, as like the reverse of December 2018. In 2018, the Fed had been raising rates. Powell did a pivot, and they stopped raising rates, started cutting them in 2019. To me, this is the exact opposite. They've been extraordinarily accommodative. They've done this pivot, and they're going to follow through. Why? They have to. Inflation is, really high. And as I've discussed in my weekly or monthly letters in detail, is we're going to see headline inflation come down. But some of the things that contribute to service inflation, I think, are going to keep creeping higher. But the headline of CPI coming down in the second quarter, I think, gives the Fed the window. Hey, we've raised rates 3 times, and we're seeing inflation come down. We can wait a little while.
Well, Jim, look, I only hear what I want to hear right now. And so, but you did bring, you brought a chart, and I think right now is probably a good time to pull that up. Yeah. So we can take a look at it on your inflation expectations, 1 year versus 3 year. Okay, explain to us what we're looking at here. Okay,
basically the New York Fed does surveys and asking people where they think inflation is going to be. Consumers type, and you can see from 2013 on, inflation was, and the consumers are always higher than the reality of inflation, probably because the CPI understates inflation, and these people are experiencing the real world. The point being is, look at how they've broken out in terms of the 1 year is the blue line. The Fed doesn't put as much emphasis on that. The red line is the 3 year, is at 4%. That's double what the Fed's target is for inflation over an extended period of time. The Fed believes it's important to contain inflation expectations. Their belief is that if people really believe inflation is going to come, they're going to change their behavior. They're going to ask for wage increases. They're going to buy stuff ahead of time because they think it's going to be more expensive down the road. And that's why they believe it's really important. So this move that we've seen, I think, is one of the reasons why you're going to hear very, very hawkish comments by Fed governors in the next few months. How are markets going to take that? Are they just going to ignore it? I don't think so. The markets wanted to believe transitory. We saw last spring, every Fed governor was out there talking about transitory. They wanted to get that message through, and markets believed it. And now I think there's a different message coming, and I'm not sure markets are completely prepared for it, which is why I have felt that we were likely to see a 10 to 15% correction in the S&P in the first quarter. And then I think there's the potential for a great rally in the second half of this year as the Fed does indeed hit the pause button. So this is kind of inside the Fed stuff, but I think it's critical because they just did a pivot.
Yeah. Well, Jim, I'll tell you, it's always insightful to meet with you every week. Today seemed to be a little bit more of a serious conversation than some of them. We tend to have a little bit more fun on Fridays, but hey, this is some serious stuff that we're dealing with, and it is moving the markets. And that's a great thing about 2022. We feel that volatility is going to be picking up, but that means that we're going to be able to trade both sides of the market. And that's what people at the Trader Summit love to see. So Jim, if I like what you do, tell me how I follow your work.
Sure. macrotides.com. And you can, check out some of the research that I do in the published reports. Monthly analysis is fundamentally driven. The weekly technical, as the name implies, looks at the S&P, bonds, gold, silver, gold stocks, and of course the dollar.
All right, Jim. Well, I want to say thank you so much for being with us every Friday. Make sure you give Jim a good thumbs up on YouTube. Comment down below in the comment section if you find anything that you think would be interesting for other traders to be learning, especially regarding this topic of inflation and what's coming ahead. Jim, I want to thank you so much for being with us, and have a great trading session. We'll see you next Friday.
Thanks so much, Blake.
All right. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.